Greetings, clients and friends of the Center. This is Managing Partner Tim Wyman, and on behalf of our 28 hardworking team members, happy holidays and welcome to today's webinar titled Year-End Tax Planning Opportunities and Strategies. Although financial markets have been quite accommodative, and at the risk of stating the obvious, we nor you can control market outcomes. But one area that we can have a significant influence or control over is income taxes. In the words of Judge Lernenhan, anyone may arrange his or her affairs so that their taxes shall be as low as possible. We are not bound to choose the pattern which best pays the Treasury. So true. So our goal as comprehensive financial planners is not to let the tax tail wag the dog, but really to help you reduce or maximize your income taxes through a variety of strategies that we're going to talk about many today. And for some, it'll be about attempting to reduce taxable income today. And yet for others, we look to even out or maximize your income tax liability over multiple years or even your lifetime. I'm excited to introduce our speaker today, Center Financial Planner Robert Ingram. Bob earned an economics degree from the University of Michigan and is a certified financial planner practitioner. Bob has more than 15 years of financial planning experience, and two of his planning interests include tax-efficient investment planning, pension analysis, and maximization. Some of you might even know Bob as the money guy based on his multiple appearances on Detroit's Channel 7 Action News. So before we get started, just one quick housekeeping item. We want to make sure we're respectful of everyone's time, so we're not going to be taking questions live on the call, but we certainly encourage all questions. And so if you want to write them down as the webinar progresses, be sure to send them to Bob or even your lead planner after the webinar. So thank you again for tuning in, and we greatly appreciate your continued confidence and trust by allowing us to do what we love, and that's to serve you and your families each and every day. Enjoy the webinar with Bob Ingram.
Thank you, Tim, for the great introduction. And I agree, there are so many different aspects and angles that make up tax planning. And really, there's certainly a number of things, therefore, that could be on your radar as we approach the end of the year. At the same time, we know that this can be a very busy time of year, and you may be focused on so many different things besides financial decisions. So we're really excited to have this annual planning webinar to highlight several important financial planning opportunities to keep top of mind in order to make the most of your resources this year in 2019, but also to have a great start as we head into 2020. So let's kick things off and start with a couple of time-sensitive items as we get to year-end. And the first, of course, is the fun topic of health care, and particularly Medicare. As we know, the Medicare open enrollment period is open right now. It goes from October 15th until December 7th. And whether you're covered under the traditional Medicare with Parts A and B and maybe a supplemental plan, Medigap, or you have Medicare Advantage plan, it's the time when you can really review your coverage, understand what plan choices have changed. We know there's a number of changes that can happen, particularly on the supplemental side. And you can switch plans, make adjustments, et cetera, for next year. And so we really encourage you to take steps to make sure your coverage is correct, to make sure it's going to fit your needs, because everybody's situation, of course, is a little bit different. Now, the Medicare premiums that you pay are, of course, determined by your level of income. So if we actually look to the left on the chart here, just as an example for this year in 2019, the majority of Americans are paying the baseline premium, which is $135.50 a month. And that means if you're a single individual, up to $85,000 of modified adjusted gross income, you're going to fit into that baseline premium. Now, if you're married and filing jointly, it's actually $170,000 is the limit of your income to be in that baseline. Above that, as your income goes into these other tiers, there are increases to your monthly premium. And as you can tell, they can be pretty significant. Now, how do they figure that out? Today, this year in 2019, the premiums that you pay are actually based on the income reported for 2017. So it's actually a look back of 2 years. So from a planning perspective, why we think this is important for many clients is looking in the future. How can we be proactive in your overall income and what is driving your incomes in order to try to control or at least influence the ranges of income that you'll be in, and therefore what your future premiums are likely to be. So again, good planning opportunity. Now, as a reminder, we have a lot of great resources available to help in making the decisions, both from an enrollment standpoint of your plans in Medicare, but also some of the the nuance that we know that exists within Medicare. As an example, we had our October webinar hosted by Callie Hassinger, who worked with one of our strategic partners, Health Plan One or HP1, with some great information, and they can be a great resource specifically to help with the enrollment and actually getting to the level of detail on a one-to-one basis, helping with plan selection. Also, on our resources page, we have the frequently asked questions, and it can be a lot of good information for just some of the basics of Medicare and some of the specific things applicable to your situation. Now, what else can be fairly time sensitive that you may need to do before the end of the calendar year? Well, if you're retired, or at least if you're 70 and a half, we know that required minimum distributions have to be taken. Now, the required minimum distributions, once you're 70 and a half, you have to start taking distributions from certain retirement plan accounts. So, for example, if you have traditional IRAs, SEP IRAs, simple IRAs, employer retirement plans such as 401ks or 403bs, 457bs, profit sharing plans, etc. If you have those plans and you are 70 and a half, for the most part, you'll have to start taking those distributions when you first turn 70 and a half in the calendar year. You have until April 1st of the next year. So if you turn 70 and a half this year, you actually have not till December, but technically until April 1st of 2020 to make that first required minimum distribution. Now, in some cases, this can make some sense, especially if incomes are likely to change. Let's say somebody is retiring at age 70 or when they're still 70 and a half, and they don't want to have to take out required distributions this calendar year because it may add to their income, changing their tax brackets and so forth. That can make sense to defer or delay those distributions to next year when maybe their income is lower. The challenge with that is just because you delay till next year for the calendar year 2019's first required distribution, you still have to take your distribution for 2020. So that could mean taking 2 required minimum distributions in the next calendar year, which in many cases that can make sense, but in other cases it might not. And then each subsequent year you do have to take out your required minimum by December 31st. Now, if I don't take the full distribution, what happens? Well, it's a pretty strict penalty. The amount that you don't withdraw, or the amount that you withdraw beyond the deadline, you can get taxed at 50% of that amount. And that can, that certainly can add up, plus the taxes that you pay on the distribution. We can see that it's pretty critical that we try to manage the required minimum distributions correctly and make sure things get done on time. Now, another question that often comes up with clients and folks that we talk to is that you may have multiple plans. What if I have a couple of different IRAs, or I still have an old employer plan, 401k or 403b? Can I just take all of the required distributions out from one place? And the answer to that is not exactly. It depends, right? Unfortunately, there's a lot of depends in financial rules and tax law. So specifically for IRAs and 403b plans, you can aggregate total amounts within each plan. So what that means is if I have 2 or 3 IRA accounts, I can look at the total contributions for each of them and take it out of one IRA. Or if I have multiple 403b plans, I can figure out the totals from each of those plans and take that out of one plan. What I can't do is cross plans. I can't total our required minimum distributions for IRAs and 403bs or other plans and take them out of one. They have to be within those 2 plans. Now, What if I have things other than IRAs and 403Bs? Well, for other defined contribution plans, you actually have to have separate withdrawals. So if you have two 401ks or a separate profit sharing plan and a 401k, you would have to take out separate required minimum distributions for each of those. And we'll talk about some strategies around required minimums. But again, we want to make sure by the end of the year that you've taken things out and that you're not going to be subject to those 50% failure to distribute or take things out a little bit too late. So we know that in inherited IRAs is another thing that is important to remember. So if you are the owner of an inherited IRA, there are no age limits or age factors involved. If you have inherited an IRA from a non-spouse, so you have an IRA account or a retirement plan, and your children inherit that, for example, they can as of right now in the tax laws, they could certainly distribute all of the funds, and in many cases we would say that's not a great idea because all of that money would be taxable in that year. They could distribute the money over 5 years, or they can take it out over the lifetime, otherwise known as stretching. And this oftentimes is the best strategy to maximize deferral and allow for that asset growth over time. But they do have to take out required minimum distributions as well. The calculation is based on their lifetime if they're inheriting it directly. But it's important to remember, if you have that inherited IRA, don't let it slip off the radar. You still need to take those out year in and year out by December 31st. Now, in 2017, what happened? We know there's been a lot of talk about it, and we're now in the second year of seeing the results, but the Tax Cuts and Jobs Act began. So I want to take a quick review and a refresher on some of those changes, because a lot of the planning opportunities and things that we've been talking with clients about the last year to 2 years really make these still very, very relevant. So quickly through, and you may know many of these, again, over the last couple of years, we've been talking quite extensively on them. So the first thing, of course, some key changes are change to the federal income tax brackets. So for different levels of income, different rates apply once you hit certain thresholds. And for the most part, they've changed and lowered almost all of those different rates at the different levels of income. Now, along with that, some of the ranges or parameters of income associated with each rate also expanded in many cases. So, well, there's been impacts of, in some cases, making an overall lowering of the overall tax rate, depending on other circumstances and other things and deductions and so forth we'll talk about. Some people have been kind of winners in that, while other folks may not have seen as much of a change. But the change in brackets overall and the change in rates is a significant difference. So the other thing that was really a big change was the standard deduction, the basic deduction that you can take even if you're not itemizing certain expense categories. In 2017, the levels it nearly doubled from 17. In 17, if you were a couple married filing jointly, that number was $12,700 you could claim as a standard deduction. Well, it went up to $2,400, and now it's actually at $24,400 for 2019. And now for a single in 2019, it's $12,200, where it was $6,350. So you can see very close to doubling. What that can mean is it may change who actually used to itemize and who actually may take the standard deduction instead of itemizing deductions. And we'll talk about how that can play out in many of these strategies. Now, the elimination of the personal exemption. So that was another deduction that you could just simply claim as yourself and for qualified dependents. And that amount of $4,050 per person is no longer available. So that's the deduction that went away. So some of the net results of this, much like the bracket changes, is when you apply the elimination of the personal exemptions, that in many cases was offset by the increase in the standard deduction amount going up or almost doubling. But in other cases, if a family had a lot of different personal exemptions taken, maybe that offset of the standard deduction wasn't quite enough. So again, we've seen some cases, for the most part, in looking at returns, where there's been a net benefit when you combine these changes. But again, everybody's situation is a little bit different. Is why tax planning is so critical. Now, when it comes to the actual itemized deductions themselves, there were some key changes, of course. And this one was pretty controversial. A lot of discussion around it, particularly for states with high state and property tax rates. Think New York, think California, for example. It used to be that there was no cap on the amount of state and local taxes, the SALT deduction. And now there's a $10,000 cap, and that doesn't matter whether you're a single filer or married filing jointly. You can only claim up to $10,000. So individuals that had very significant SALT deductions or state and local tax deductions are seeing really a limit on their itemized deductions. There are also some changes with elimination of miscellaneous itemized deductions. Some of the things like moving costs, unreimbursed business expenses, certain professional service fees, etc. Those have gone away. So individuals that used to have a lot of those expenses and costs that they could deduct as part of their itemized deductions are no longer there. Now we've seen the expansion of the child tax credit. Now that's a nice thing that can help offset some of the reductions in personal exemptions for families. Now the child tax credit is a credit. The difference from a deduction is the credit is a dollar for dollar reduction in actual tax liability, whereas a deduction reduces income that gets applied to a tax rate to determine tax liability. So the credit can be really effective, and especially in the lower tax bracket you are, the more the credit can make a big difference. So it used to be $1,000 per qualified child, dependent under 17, and that's actually doubled to $2,000. And also the limits. There used to be income limits that you had to fall within in order to qualify for the child tax credit. And so for single individuals, it was until 2017 up to $75,000, and then it would phase out and you wouldn't be eligible. For a married couple, $110,000. Well, that actually has gone to, for single individuals, $200,000. So you can earn and have income up to $200,000, adjusted gross income, in order to still qualify. And for a married couple filing jointly, that limit is $400,000 before the phase out. So it makes it eligible or makes it available to a lot more people now than previously under the other tax laws. So that can be, again, a good advantage in terms of looking at the total tax liability compared to 2017 and before that. And some other things, as an example, is state tax exemptions almost more than doubled. It's actually now for individuals up to $11.4 million is the exclusion of total assets from estate tax. And through proper planning and preservation of those credits, married couples can actually exclude up to $22.8 million. So some large amounts there as well. So when we think of some of these strategies, what is the impact that these changes have had, and what can we actually do in our planning and things that can help to reduce or better manage your tax liability going forward? So let's take a look really quickly at just a highlight of some of the tax bracket changes that we saw through the Tax Cuts and Jobs Act. As you can see in 2017, for different ranges of income, there are certain tax rates, of course, applied to income once it hits those thresholds. So as an example, if you're married filing jointly, the first $18,650 of taxable income, a 10% rate was applied to it. The next from $18,061 up to $75,900 was taxed at 15%, and so on from $75,901 to $153,100 would be taxed at 25%, and again each bracket from there on out the same thing would apply. So we saw in 2018 Tax Cuts and Jobs Act that the rates applied to these general ranges of income brackets changed. So 15% to 12, the 25% down to 22, the 28% to 24%, and so on. And while the ranges are close, they're also, it's notable that there are some little bits of the parameters of the range of incomes are slightly different in certain brackets than in others compared to 2017. But the point to this is understanding where your income and your taxable income falls within these brackets, or where your last dollar would fall, your next dollar that you would have as taxable income. Depending on the bracket you're in, that's going to influence what your overall tax rate is. So if somebody has $159,000 of income, is a single individual, they're right in this 24% tax bracket for this amount of their income. So if they were to add income of another $5,000, let's say, that pushes them over 159 to 164. So anything above the 160,725 now gets taxed at that 32%. So there are lots of opportunities where possible to maximize income within the bracket. So does it make sense, especially if you're in the lower brackets, to actually take advantage of income up until the next threshold? Now, if someone is just above a threshold, are there ways to lower the income or try to get as many deductions or to reduce taxable income as much as possible to make sure that you're in the next lowest bracket? So let's say that, again, the single individual here has an income of $85,000 or $86,000. That person would have $86,000. They're in that 24% tax bracket. But if the income were just lower, just enough to be moved to the 22%, that at least keep those last dollars from hitting that next tax bracket. So in those cases, trying to manage income and maybe defer some income can be helpful, especially when you're talking about strategies that may add income, or for retirees that have multiple sources of income, and there's a decision as to where do I create my paycheck? Will it create more income or will it not create more income? These are the planning opportunities that we obviously want to think about and look at, especially as you kind of near year end and are projecting income forward. Now, other rates, as far as long-term capital gains rates, are tied to the level of income that you have. So based on your taxable income, it'll determine what capital gains rate would be applied to those realized gains. So for, let's say, a married couple filing jointly, up to $78,750 for taxable income. If there are any capital gains that make up that income, those gains would actually be taxed at 0%. Can be pretty effective if we can manage and look at ways to try to have your income fall within that. There's an opportunity to capture capital gains and realize those literally at no tax cost, at 0%. Now, as your income starts to increase, and this range is pretty wide, you would then have capital gains rates of 15%. And then above a certain level of $488,851, then the capital gains rate actually jumps to 20%. Let's talk a little bit about a couple of opportunities that, in particular, that have been kind of confusing as it relates to the tax law changes over the last 2 years. And in particular, let's think about charitable giving. I know there was a lot of questions clients had, and there was a lot of articles and discussions in the media and confusion around, well, are charitable gifts and charitable donations still tax deductible? The short answer is yes. Nothing has changed as far as the deductibility of charitable contributions and charitable gifts. What happens is that whether or not someone is going to itemize their deductions and actually be able to make a deduction, that's what has changed as a result of the tax law changes. So just a basic example, cash donations. Let's say you were going to make a simple writing a check to your favorite charities. How does that work? Well, if you benefit from the tax benefit of donating cash is that it is simply deductible as long as you itemize. So it's deducted from income. It's one of the categories under the itemized deductions. So if you give $10,000 and that number plus your other itemized deductions, where it allows you to to decide that it makes sense to use the itemized deduction as opposed to the standard deduction, well, that's great. That's still absolutely deductible. But are there some other opportunities besides just getting that tax deduction and giving cash? And one of the things that we actually will talk with clients about pretty extensively is the use of donating appreciated securities or appreciated capital property. So think stocks, bonds, mutual funds, even real estate to an extent. Giving those types of securities instead of just giving cash has a couple of benefits. Well, number one, if itemizing, it's still a deduction. That amount is still potentially tax deductible. But the other benefit is that you have the opportunity to avoid capital gains taxes that you would have on the securities that you donate. So in other words, if you were to give cash, but in order to get those cash proceeds, you were going to sell some securities first, take the cash, and then give that as a cash donation, you would still have to claim the sale of those securities as part of potential capital gains, but then you just get the deduction from income. There's a benefit of actually giving those securities as the charitable gift, because giving the securities avoids the capital gains. And let's take a look at how that actually could play out. So a quick, simple case, let's say client Cindy and Joe. Cindy wants to donate $20,000 to her favorite charity. And she has different options. She could give some cash, or she could sell some securities. Let's say she owns 100 shares of Apple stock, and now it's worth $20,000, $200 per share. But her cost basis when she purchased that was $20 per share. So her cost that she has is $2,000. So if she were to sell the shares of Apple and then donate the cash, she may have capital gains on the difference, on that $18,000 gain that would be due, and then she makes the charitable contribution. So what is an alternative to doing that? Let's look at a comparison. So in this case, you sell the shares, the base is $20,000, you've got the capital gain of $18,000. So let's say based on their income that they have, they're in the capital gains rate of 15%. So $18,000, 15% taxes on that, that could mean taxes of $2,700 on that $18,000 capital gain. Now, let's assume instead that Cindy was to take some of those shares, so take the 100 shares, donate the shares themselves to the charity without selling them first. Now, so in the case, still have the $20,000 of total value, basis of $2,000 with the unrealized gain of $18,000, but now you don't pay those capital gains taxes, you actually avoid them. That's an actual tax savings of potentially $2,700. So not only could you avoid some of those capital gains on appreciated securities, but then Joe and Cindy may also be able to get those as a deduction on their taxes if they itemize. Now, so one of the issues that I know has come up in particular with this is, well, what if I was able to itemize based on the different deductions that I had as of the laws in 2017, but now because of some changes like the increased standard deduction or the reduction in the state and local taxes, the cap of $10,000, or the elimination of miscellaneous deductions, what if I'm just not able, or I don't have enough deductions to exceed the standard deduction? Well, there'd be no reason to itemize in that case. So by gifting, you may not see a tax benefit, because if you're not itemizing, you're not getting those deductions. So one of the things that some clients may want to consider is grouping together multiple years gifts. So for example, if I have I usually donate $20,000, but I do that over the course of 5 years, and I have $4,000 a year, and that's my normal gifting that I want to do over the next 5 years. Well, what if I were to gift that $20,000 now and do basically 5 years of giving up front? That's kind of what we call bunching or lumping gifts. But maybe I don't want to do that. My charities like to have a gift every year. I don't want to have to just gift one time and then not give again for a number of years. So it doesn't always fit everyone's situation. So another opportunity that really it can be an effective way to do that is through something called the Donor Advised Fund, or acronym DAF. And what it is, it's a program that is set up like a public charity. It literally is a qualified charity. Financial institutions can sponsor that. Sometimes charities themselves can sponsor their own Donor Advised Fund. And you would set it up where you are the primary grantor. And so you actually create the fund, or have the sponsored fund that you make a donation to. Now, you make the donation to the Donor Advised Fund because it is classified in of itself as a qualified charity. You can get the deduction at the time you make the contribution to the Donor Advised Fund. What you're able to do then is request grants, and you can request that over whatever timing. So let's use that $20,000 example of gifting over 5 years. You make the contribution of $20,000 to the Donor Advised Fund, but you decide, well, this year I'm going to grant $4,000, or request a grant of $4,000, and then I'll do that for the next 4 years. So I still have my 5 years worth of $4,000 gifts. But you're able to get enough of a 1-year tax benefit, because assuming that your 20,000 gifts allows you to exceed the standard deduction, it would make sense to take that take that itemized deduction. So it really provides a tax deduction in the year that the contribution is made. That's key. You can actually invest the balance. So this is an investment account. You can actually choose investments, allow those funds to still grow while you wait to request those grants and distribute those funds to the ultimate charitable destinations. And again, you can make the grants really when you're ready to do so. So again, it can be pretty effective. Now, another strategy that's very, very popular, and probably one of the most effective ways to give, particularly under the current tax laws, would be for those individuals that have achieved the age 70 and a half, and that's qualified charitable distributions. The way this works is you actually are making a tax-free distribution from your IRA directly to a qualified public charity. Now, the key is it has to be from an IRA type account. So you wouldn't be able to do this from a 401k or a 403b plan, et cetera. It has to be from the IRA. And of course, the IRA account holder has to be of the age of required minimum distribution. So you have to reach age 70 and a half in order to be able to do this. Now, you're not limited, though, to only your required minimum distribution amount per year. The amount per person per year is actually up to $100,000. So it's a pretty large amount that an individual can request donations from the IRA. Now, why would this be effective? Well, in the case of a retiree or somebody that's age 70 and a half, possibly can't or wouldn't choose to take the itemized deductions, they're going to take the standard deduction. They would normally not see an economic benefit to making those charitable contributions. But if you're able to do this and use a qualified charitable distribution, remember, the distribution is excluded from income. So it actually doesn't even add to your gross income before you even get to applying whatever deduction. It's right off the top. It's almost like an upfront deduction, if you will. And so you're still getting the benefit by lowering your income. You're just not having to do that through deductions. You're doing that right through the exclusion of income. So it can be very effective, and we look at ways to do this. If you're still considering charitable contributions by the end of the year, and you want to have these count for your 2019 taxable income, certainly have a conversation, with your advisor planners around this if there's still last-minute gifts you want to make. And we usually say most firms will say, a couple of weeks before the end of the year. You don't want to get so far into crunch time to risk not having those checks go out of your IRA before December 31st. So what are some other strategies that we'd want to look at potentially, and how can they make a difference? Well, Roth conversions have been an opportunity over the last several years, certainly a popular option as a way to have more funds moved from a potentially all taxable type account, a regular IRA, over to an account, the Roth IRA, which can grow tax-free. So the way this works is you're actually moving funds. You're distributing funds from traditional IRA or pre-tax IRA, and you're moving them into a Roth IRA. Now, this shouldn't be confused with an IRA contribution. It's separate from a contribution, so you're not restricted or limited based on Roth IRA eligibility criteria. There's no income limit that restricts someone from making a Roth IRA conversion. But there are certain factors that we, of course, have to be aware of. So when you're converting from a pre-tax IRA to a Roth IRA, the income from the pre-tax IRA is going to be fully taxable. It's going to add to your income, and it's going to be taxed at your ordinary income tax brackets. So where this can make a lot of sense typically is if you're in the lower tax brackets today, and maybe you might think your income will be rising in the future, and that could be 1 year, 2 years, it could be 20 years from now. You know, for younger clients, people starting out in their careers that expect to have higher incomes the further on they go in their careers, maximizing the opportunity to get money into a Roth IRA can make sense. You don't necessarily you have to pay the income today, but it's at potentially a lower tax bracket than in the future. So what happens is that money now grows within that IRA and grows tax deferred. But in most cases, if you're over 59 and a half and you've had the Roth in place for at least 5 years, you're going to have fully tax-free withdrawals from the Roth IRA. So in the future, when you're drawing income, there's a source of income that you don't have to pay taxes on. Now, with the current tax laws in place, this has been really compelling, particularly with the brackets that have lowered, so that the 15% down to the 12% bracket we talked about, and the 25% bracket down to the 22% bracket. So when there are years where income might be a little bit lower, a lot of cases we will work with clients that are not quite to the age of taking required minimum distributions. They may be retired, so their income from earnings isn't there anymore. Maybe they're delaying their Social Security benefits, so the Social Security income isn't there that could add, at least in part, to their taxes. So they may be drawing income from sources that don't add much to their taxable income or bracket. In those cases, it can make a ton of sense to actually do a Roth conversion, filling up those lower brackets, so that in future years, they have more money that can be taken from that tax-free source of the Roth IRA. Even if we see tax rates stay the same, and we know that the current tax rates are set to sunset, which means if nothing happens, if they're not made permanent, by 2025, they're set to revert back to the same rates of 2017. So there is a possibility we could see rates go back up in the future. This would make a great ton of sense. If rates stay the same as they are, well, then it's really kind of a break even, because you may be paying today at a 12 or 22% tax bracket, and in the future, if the rates are the same, you'd be paying a 12 or 22% tax bracket if you took income out at that point in time from the regular IRA. So either way, there could be some good advantages there. Now, the other thing of a nice part about the Roth IRA is that there are no required minimum distributions for the original Roth IRA owners. Whereas, of course, as we talked about, the traditional IRA and other retirement plans have required minimums once you hit age 75. So folks that have large amounts in retirement plan assets that are pre-tax may be looking at significant income that they will have to draw out once they hit age 70 and a half. So Roth conversions can be an effective tool in some ways to reduce the amount of assets in pre-tax accounts. By making conversions to Roth, there's less money in the pre-tax IRAs, and therefore the required minimum distributions could be lowered strategically over time, and it's definitely something to look at by looking at your income and understanding where that income is likely to be. Now, of course, for non-spousal beneficiaries, that's the one exception. With Roth IRAs, if you're a non-spouse beneficiary, again, let's use the example of children inheriting or grandchildren inheriting a Roth IRA. yes, they would have to take some minimum distributions. But again, if it's done properly, it's not going to be taxable to them, but there are distributions. So by lowering income, or the opportunity to lower income, we can really have also a potential impact on managing Medicare premiums. If we can get and lower your incomes over time so that you don't go into those higher premium income thresholds, you could save potentially thousands of dollars on Medicare. So when we are looking at these tax strategies and income distribution planning with clients, we really also want to be very conscious of the potential impact on Medicare and what those premium costs could be. And then again, the other benefit, of course, is just having other buckets. The tax treatment, diversified tax treatment. We talk a lot about diversifying investments, but this is about diversifying the tax treatment on different types of assets that you can use for income. How are those taxed, and having different ways that they're taxed. Things like pre-tax IRAs that may add to your income, along with whether you have pensions or Social Security, capital gains-based assets and qualified dividends that might be at long-term capital gains rates. Those in some cases, 0 or 15%, might be lower than your ordinary income bracket. Have some monies that come from that at a lower rate. And then by having some tax-exempt or tax-free income gives you that flexibility of where to pull money from when you're creating that paycheck in the future in retirement. So now, just as we kind of wrap up with some last-minute items, kind of think of these as good, important things to consider in terms of housekeeping items. How do we manage tax-efficient investing? And there's been some studies over the years. This is an illustration that Russell Investments has done about what has been the impact. What's the negative impact that taxes have on overall portfolio performance and what that drag is? And over the years, looking back 5 years from March of 2018, and their studies showed that 181 basis points, which effectively is 1.81%, of returns can be lost by just tax drag for U.S. equities. And for fixed income, or so the bonds, the studies show that maybe 1.35% is lost in not managing taxes as efficiently as possible. So what are some ways that we think about managing taxes from your regular investments? Well, when you're talking about taxable investments, now these would not be within retirement accounts. These are just regular investments that as you have realized gains or income or interest, you pay as you go. You get those 1099 and interest and dividend statements each tax season. It's those kinds of investments we're talking about. And one thing that you'd be able to do is loss harvesting. So if you do have some losses of some securities or holdings within your investment portfolio, you may have the opportunity to sell at a loss. The losses can then offset any particular gains that you might have realized. So it's a way to control your overall short and long-term capital gains that you have for the year. Now, the other thing that you can do, and we think about this quite a lot, would be asset location. And that's how do we think of what types of asset classes should we have in the different accounts or the different product or different securities that are taxed in unique ways. So, for example, if we're looking at somebody that's in a very high income tax bracket for ordinary income, and we know that interest is added to ordinary income, so that bonds in a portfolio, certain kinds of taxable bonds, or types of funds, or ETFs, exchange traded funds that may have a lot of capital gains that do a lot of trading over the course of the calendar year, those capital gains could create more taxes. It might make sense to have more of those types of assets or securities in tax deferred accounts so that year in and year out, those can generate income or generate gains, but you're not having to count those gains on your returns when they happen. Now, conversely, things that are more efficient, long-term capital gains, dividend income where it could be at a 0 or even a 15% tax rate, maybe we do have more of those in regular taxable accounts. For folks in higher tax brackets where municipal bonds could make sense, we might consider having those in a regular taxable account because municipal bonds are not subject to federal income taxes. So there's some tax savings there. So where to position assets and taking a look at your overall portfolio is critical, and particularly at a time like this where we have seen, an overall markets, really have a good year and have some gains built up. It may be a good time to revisit this, to look at the portfolio, make sure things are still in balance, and identify some of these opportunities. Now, in terms of loss harvesting, just to kind of hit on a few of the mechanics that are important to remember. So you're selling positions when you're loss harvesting that have decreased in value, and you have to sell them by year end to count them for, of course, this tax year, to realize that capital loss. I mentioned that losses can offset capital gains, so that's a good advantage. But then if there are losses that exceed capital gains, you can actually offset $3,000 of ordinary income. That literally is like another deduction from your other sources of income that are added on to your taxes. That's the max. So any losses that exceed that $3,000 can be carried forward to the next tax year, but at least you can offset some income with excess losses up to $3,000. Now the key point is you want to be able to maybe repurchase a similar security or something in that same asset category, but the IRS has a rule, and it says you cannot repurchase the like security within the same 30 days. And that could be 30 days before the sell for the loss or 30 days after. So we've got to wait 31 days if you were going to be reinvesting in the same position or the same security in order to avoid that restriction, what's called the wash sale rule. And so these are important things to discuss, talk with your planner about as we get to the end of the year, and you want to maybe do some tax loss selling or even some gain harvesting. If you have some losses available, could be an opportunity to then capture some gains that will be offset by those losses. Now, how about employer contributions? If you're looking for ways to try to increase some retirement savings, for 2019, we had some increases this year for the 401k, 403b, 457 type plans. The maximum annual contribution is $19,000, and if you're over age 50, it's another $6,000 for a total of $25,000. Simple IRA for self-employed individuals or individuals in small businesses that have a simple plan. The contribution is $13,000, and then if you're over age 50, another $3,000 to get you a $16,000. And then the traditional and Roth IRAs are $6,000, and if you're over age 50, an extra $1,000 to get you to $7,000. So some things to consider of traditional, tax deductible, and the benefit of reducing income. Your pre-tax, tax deductible plans, 401k, simple IRAs, 403bs, and traditional IRAs. The benefit there is you're going to be reducing your income for every dollar that you put into the plan. It's excluded from your income off the top. However, when you take the funds out, those distributions are taxable and they add to your ordinary income. Whereas, as we talked about, Roth IRAs or Roth 401ks, you see in a lot more plans now, you don't get the benefit today of deducting those contributions you put into the Roth 401k plan, but as you distribute those dollars, they're non-taxable. So again, it comes back to the balancing of what are the priorities that you have today. Does it make sense to defer more income, particularly if you're in a higher tax bracket today and expect to be in a lower bracket in the future? It might make sense to add more to the pre-tax portions of the plan. Whereas if you're maybe in a lower tax bracket or have a year that might be a lower income year, adding to the after-tax side allows you to build that bucket of tax-free growth and tax-free distributions. So looking at where you are and where you expect to be, these are a lot of the planning elements. We look at your situation, and it's very helpful to see what your income is projected to be. Now that we're toward the end of the year, you can make some better assessments. In some cases, if you're not at those levels of maximizing those contributions, many clients that have an opportunity to have good cash reserves, it can make sense to try to kind of max fund the rest of the year, put in as much of your salary percentage to your retirement plans as possible to get as close to the maximums, or at least position your percentages and your payroll deductions so that next year you can start at a higher and higher amount to get more money going in those areas for 2020. Now, the last couple things, health savings account has been a very popular tool, as we've seen, and this graph really shows the growth of the health savings accounts. And these are savings accounts specifically that go along with high deductible health plans. And there are several benefits to it. But the way it works, it's a type of savings account that has some very unique tax advantages. We like to call it, or think of it as triple tax advantages. So the way it is you put in money pre-tax. So you actually deduct the contributions that come right off the top. And again, this is not an itemized deduction. This comes right off and is excluded from your gross and adjusted gross income. Or if a health savings account or HSA is associated with an employer plan, it may come right out of payroll and it's excluded from your gross income before you even see your paycheck. Now, it also can grow tax deferred. If you're familiar with flexible spending accounts, there's a big difference there. Flexible spending accounts were designed to be accounts to have cash for healthcare costs, but you had to use them in that same year. Otherwise, you would lose them, use it or lose it. Health savings accounts are different. Health savings accounts continue. You can put money into a health savings account and you don't have to spend it in any one year. It can continue to build and grow, and you can actually invest it. And the different health savings providers may have different reasons or different accounts or investment securities and funds that you can invest, much like you might have for a 401k plan, et cetera. And those funds can build. So as they build tax deferred, you're getting that growth, but you don't have to realize the gains along the way, just like a tax deferred retirement plan. Now, you can use those funds if you needed to pay an out-of-pocket expense for your medical care, for qualified expenses, tax-free. So there's the triple advantage. The contributions are deductible. You can grow the funds tax deferred, and then when you take the funds out for a qualified medical expense, you don't have to pay taxes. So you never see the taxes on that. That is really a pretty effective and powerful tool. Now, you can contribute all the way up until you actually hit 65 and you enroll in Medicare. However, what are some costs that you can use from the HSA that count for those qualified expenses? You could actually use those dollars in the HSA to pay Medicare premiums or even long-term care premiums. You can also build up excess funds by allowing that money to defer, to have sort of a side fund that could handle different kinds of out-of-pocket expenses in retirement. In addition to that, once you reach age 65, you actually can use funds from the HSA for any purpose, but you still have to pay taxes if it's not for a qualified expense. If you're under age 65, there are penalties for distributing money and using monies from an HSA for non-qualified expenses. And that penalty is 20%. So similar to a retirement plan, you get that 10% penalty if you take money out. In most cases, let's say from an IRA, pre-tax, or from a 401k plan, if you're under age 59 and a half, you may have a 10% tax penalty. For the health savings account, it's a 20% tax penalty. But over age 65, once you reach that age, you can actually use those funds for anything. You would pay taxes on things for non-medical expenses, and you would not pay taxes on those distributions for qualified medical expenses. So definitely a good opportunity there. Now, you have until April to make contributions for this current calendar year. So while it's nice to have it as a planning item, and if you have some opportunity to add to your HSA this calendar year before December 31st, that's fantastic. But don't feel like you absolutely have to get this in by December 31st. You have until tax filing to make additional contributions to an HSA, and then still have the tax benefit or the tax deduction lowering your income for this year, 2019. And finally, this year, a lot of clients and folks are thinking about gifting, and there's different ways to gift. And we're not talking about charitable gifting, but maybe gifting to family or friends or people that you care about. So from an estate tax perspective, as part of individuals' plan giving, we know that there can be an annual exclusion amount that you can give that doesn't impact your overall estate tax exclusion. And that is $15,000 per year per recipient. So you can literally give away $15,000 to each person that you'd like to this year, and that money is now out of your estate from the purposes of estate taxes, but your exclusion, that very large exclusion that we talked about in the tax law changes earlier, that is not affected. You don't have to change that. You still preserve that full exclusion. Roth IRAs are another great example and can be an effective way to gift, particularly for younger family members that might be starting in their career, and you're just saying, well, what are some ways to really help jumpstart our children or grandchildren's savings? You can make a contribution to those individuals that can then add it to a Roth IRA and get money growing in a tax deferred and potentially tax-free way. And of course, as we talked about, the limit is $6,000 for a maximum contribution, but an additional $1,000 for over age 50. But a key thing is to make an IRA contribution, the recipient has to have earned income. So whether it's a grandchild with income starting out, or somebody later in life, they do have to have earned income at least in the amount or more of the amount that you're going to contribute to them. And finally, 529 plans, so college savings. Again, that's top of mind for a lot of clients for children and grandchildren. It can be a great way to gift. Not only is it a great way to gift from an estate tax perspective, but there's a lot of great tax benefits for those college savings plans. So money is contributed, and there's no federal tax deduction on those contributions. There can be a state tax deduction if you're saving into a Michigan-based plan. But the dollars do grow tax deferred. And then if the dollars are used for qualified education expenses, they are tax free. So it's similar to how a Roth IRA for retirement expenses grows tax deferred, and then if you withdraw those dollars can be tax free. 529 plans for specific qualified educational expenses can be distributed tax free. And so, again, it can be a great way to help boost children and grandchildren's college savings and have some tax advantages. Now, with the Tax Cuts and Jobs Act, one of the changes was that it allowed for 529 plan distributions to be used for K through 12 expenses up to $10,000 per year. So from a federal tax perspective, you can do that, and you don't have to pay taxes on those distributions. Previously, it was only for qualified college higher education expenses, but now it's available K through 12. Every state has their own rules as far as state taxes. In the state tax rules for distributions, and many states have not yet allowed for this rule as far as K through 12 expenses. But from a federal tax standpoint, a federal income tax standpoint, those are tax exempt distributions. So that's really all we had. I know there's a lot of information that I covered today. There's a lot of things to consider in your planning opportunities. But just really wanted to, as we wrap up, remind you that there may be some topics that I covered today that really resonated with you, and some things that you may want to look at again and review again. Well, we're going to be sending out a recording of today's presentation to everyone that joined today, and that'll be going out within the next couple of days. So keep your eyes open for that email with a link to the recording. And if you do have questions as you're going through it, please don't hesitate to reach out to us. Reach out to your planner. Feel free to send me an email or give a call to the office. We'll be happy to answer your questions or point you in the right direction. And then certainly don't hesitate to pass the recording along to any friends or family you think might benefit from the information. And also, I encourage you to visit our website at centerfinplan.com. And there you're going to find a lot of other additional educational resources. Particularly, we have our year-end tax and planning guide, and it outlines a lot of different strategies, several strategies and steps to take. Many of the concepts we covered today are described in there. And to find that guide, just go to the Resources tab on the website, and it's under the Handy References section. So once again, I want to thank everybody for your time today and attending, and I hope you have a great rest of the week and a wonderful holiday season. Take care.